A phenomenon called the yen carry trade is in focus this week in the world of investing. And believe it or not, its origin goes back to Japanese housewives, collectively called as Mrs. Watanabes about 20 to 30 years ago. So soon after the Japanese stock market collapsed in 1989, Japan's interest rates have been close to zero or even negative. Now Mrs. Watanabes would borrow this money from Japan at almost zero interest rates and invest it in global markets and treasuries. This is called the yen carry trade, and it was soon also executed by large global financial institutions. In fact, the value of this is estimated to be a whopping 4 trillion US dollars. Imagine borrowing 1 lakh from Japan and then converting it into a different currency and investing it in a stock that gives you a 10% profit. So now you have 1.1 lakh, but you only have to pay back 99,000 because of the negative interest rates in Japan. So you make a profit of 11,000 rupees. The yen carry trade has much higher chances of success if the Japanese yen does not appreciate in value and the Japanese interest rates stay zero or negative. But that changed in March 2024 when the Bank of Japan increased interest rates in Japan for the first time in 17 years. And then it was hiked once again just last week to 0.25%. At the same time, the Japanese yen has soared about 10% against the US dollar in the past 1 month alone. This can push traders to face losses and even margin calls, potentially making them want to sell stocks, convert that back to yen to repay their loan.
Investments in securities market are subject to market risks. Read all related documents carefully before investing.